Good morning, subscribers. Time to review all the charts for the next week. And this is probably one of the toughest markets we have encountered in the past, I don't know, certainly 5 to 10 years, because it's a highly technical market in which very little is actually trending. In fact, we can't find anything that's trending, and everything is in a wait to see pattern and trading the pattern. To your note, if you remember, we actually did the last video, the updated video, when it broke this line, and we said that basically it was just yield curve flattening, and that's exactly what's happened. The 2-year note has done absolutely nothing since then. Is this a bullish pattern? No. But on the other hand, is it a hugely bearish pattern? It's basically a market which goes and trades levels. Here in this area here, it's an indecisive market. In this area here, it's a market which is saying no Fed hike. And when it trades below this, it's a market that's saying, yes, okay, we're going to get the Fed hike. But we just don't see it trending through these levels. So we're trading 4 or 5 ticks from the lows, and even in the middle we're trading 4 or 5 ticks from the top and the bottom. So it's a very tough market to position yourself in and say, yes, I want to keep this position for a long time. Anybody who was short here probably is already covered and is now waiting for the next piece of information. 5-year notes, it's exactly the same, slightly less bearish than the 2-year note. It still hasn't bust through this channel, and I don't think it will. It might try it a couple of times, but that's about it. It's got very good support here on the dailies. It's very tough to crack this kind of moving average support with all the moving average still pointed upwards. It's very tough to crack it on the downside with any conviction, like we did here, without particularly bad news. We need some amazing data which shows that the economy is amazingly strong. Are we likely to get it? In my opinion, probably not. Certainly not in the next couple of weeks. 10-year note, again less bearish than the 5-year note. Yield curve flattening, maybe that is the trade, just flatten the yield curve. But on the other hand, it's already so flat. How much flatter can it get? That's what we keep on asking ourselves. Do we really want to be caught with that position? Again, this is a market to do absolutely nothing in. It's stuck in this kind of range, and that's all that can be said. 128 is the bottom, 131.16 is the top. That's all that can be said. There is no trend in fixed income. The 30-year is again more bullish than the 10-year. Yield curve flattening, that's all there is to be said for it. The Europeans, dead as a dodo. There's no movement at all in the shats, no movement at all in the bobble. I mean, look how tight these ranges on the bars are becoming. If you make 2 or 3 ticks, you consider yourself lucky. Bund, which I know a lot of people are dying to get short of, well, absolutely no reason to short it. While it's above this center line, while it's got the moving average support, while it's got the Bollinger Band support, MACD not particularly bearish, it could actually start turning. There's nothing at all to do here, nothing at all. We would love to be short of it, but we see absolutely no reason at the moment to short it. Even on the weeklies, what a mess. 1, 2, 3, 4 candles up, 3 candles down, 1, 2 candles up, 1 candle down, and the ranges keep on getting smaller and smaller, and this Bollinger Band keeps on tightening, and telling us there is absolutely nothing to do for the time being until this concentration busts. And again, you have to be patient. When there is nothing to do, do nothing, because it certainly doesn't pay to try and anticipate the market too much. And all that ends up is that you lose money and you get annoyed, and then potentially you lose the big trade once it's triggered. Yes, in fact, this is the SPX. Um, we keep on kicking ourselves that we missed it by a couple of points on the downside. It's in this down channel. It's been correcting now for nearly 4 weeks, and we've come down what, 2%, 2.5%. Not the stuff of bear markets. It's still in this downtrend, although if it starts breaking the 2075 area, it'll be through this line, and this will look like I guess, a bear flag, or rather bull flag, and it'll start breaking upwards. But again, it's very tough to see it going much below 2130. So if you bought it 2175, 2080, you would be playing it for 50 points, which is 2%. Tough to do that in any size because you're so close to the highs that it's very, very tough to do it with any conviction and any size. On the other hand, the downside looks very protective. If it doesn't stop in this area that we keep on mentioning, then the 2000 area with the 38% retracement is going to be very, very, very tough to break. Again, we think this is a hit and run market, a market in which you have to be very patient, in which you have to trade your levels because you've come to the conclusion that those levels have value, as we think that this level potentially has value, and have a predetermined stop and know exactly where you're going to get out. And probably what you have to do is play it with greater size and tighter stops so that you extract some value from the market. We know it's very, very tough. That's why we're doing very little, and we are basically doing it in larger size when we see a potential trade. There is really nothing which is leading here. The emerging markets index came within a whisker of the 3150 area that we keep on mentioning, and poof, nice doji reversal. Annoying. We might still have to buy it next week without it reaching those levels because we think it could potentially go and fill these gaps here around 34. Well, that's a 5-6% move. That would certainly give you a 3% move in S&Ps. That one might take it S&Ps to 2100. It's tough to see what's going to smack it down that much more, because there is so much liquidity in the system. There are so many people who don't know what to do with their money, and it seems Tina keeps on raising its ugly head. There's really nothing much to be done in any of these markets. I mean, even the NDX that we keep on looking at just to see if this might be a reversal sign because it double bottomed here. Well, look at it. Moving averages will be in here next week, 44.15. By the time the Bollinger Band has come down, 45.15, 44.15, 44.25 is going to be huge resistance. And we are at 43.65. Well, that's 2%. Do you really want to commit the totality of your capital for a potential 2% move on the upside? Well, we certainly don't. So basically, it will just mean trading it, and having tight stops on the downside, and that's all we can do. We hate this kind of market because we much rather position ourselves for a trend, but we can't really position ourselves for a trend like here until this trend starts developing, and here, no trends. Highly technical market, grab your 10 ticks where you can, and that's all there's to be said for it. Now, the one thing that we think will develop this trend is sterling. Now, we've gone back and looked at these long-term charts, long-term weekly charts, and we think that primarily without the excessive bullishness or excessive bearishness, we are in this kind of gentle downtrending channel, which makes sense because if sterling, if the dollar has slightly higher interest rates than sterling, and sterling is more tied to the euro, it is bound to have a slight downward slope compared to the US dollar, which doesn't mean that we can't go and trade back up to the, what level is that? That would be around 155. Which is the 50% retracement of this whole move down. We will do a separate video about Brexit next week, but just if you think that a lot of people have been selling sterling to hedge themselves, I mean, there isn't a single money manager in the UK which is not to some degree hedged against the dollar, against the euro, or against whichever currency he prefers, because he would just lose his job in case of Brexit. So, you know, they splash out some premium and they buy protection, and then what happens to the market makers who sell the protection? Well, they have to hedge it, so they sell some spot sterling. You know, this is basically where the referendum was announced, these kind of levels, 155, 152, 153, and since then it's come down 6-7%. So by all logic, if the referendum result is a yes, we should come back 6 or 7% to where we were. I'm not saying that that is all we're going to get. We're saying that that is the minimum we should get. So sterling, when it starts coming down to these levels around the 142, 143, 144, it's certainly worth a long shot. So that's the only thing that we think might be starting to develop. We've only had a quick ABC up to retracement. We think we're going to start getting a decent move in that direction over the next month, because the market will always anticipate Brexit. But we'll do a special video about that. The trades that we've done over the past couple of days, you know, Euro Canada, this is now a, you know, at least a 5 wave up. We will hopefully, this is was 3 of 3. We will get now the 5th wave that will take us up to around the 195, 198 area, and we certainly intend adding to it when it comes back down to this kind of level, 188. 188.35. This kind of level we will definitely be adding to the trade, because we think sterling is still safer to play on the crosses. And against the Swissy, you know, when we start getting back down towards 142 and a quarter, we will definitely add for the next leg up. We certainly think that the Swiss, sterling against the Swiss, looks a lot better and has a lot more potential. We think it goes back up to this level, 154, 155. So it has more legs than against the euro. The euro, which is again some sort of a bellwether for everything that is going on, is again telling you that, well, nothing is going on. It keeps on trading very tight ranges just above the 200-day moving average. Now we've had this move up, which wasn't sustainable because we were through all the Bollingers and this major line. We've come back to the bottom of the Bollingers, and look how oversold the stochastics are. So over the next few days, buying some euros might be profitable. We certainly should go and test 113.15 again. So, but those are all very, very small moves. Again, maybe the answer is to trade less, trade in larger size, and get out sooner, and not even wait for any kind of trend to develop, because it just won't. On the hourlies, you might see it a little bit better. Here's the moving average that caught the whole move. We might go and retest it, 113ish, 113, and that will be the level, which actually ties in with the daily on the dollar index, which basically is now very overbought, and it's come up to this channel top resistance, and it might easily come back down towards the 94.30 level, which would basically be a buy again for the next leg up, hopefully. So corrections within corrections within corrections is all that we are seeing for the moment. There's absolutely no long-term trend that we can spot. Gold is doing the reverse of the euro. It's basically trying tops, it's trying bottoms. It's playing within Bollinger Bands, and it's playing the technicals beautifully. We doubt very much is going to bust through this line anytime soon. We might have another week of downside to get it towards, I don't know, 125, 122. 122 is going to be very, very important. But that's about all you can say. You know, if we see we're slightly short of gold, if we see it at 122, we will be thinking of getting long. Again, a market which just you should trade two levels, pick your level, decide which way it's going to go, and trade it like that. Silver, not much to be said about it. The support line is going to come around the 16 hour level, which is going to be very important. If you bust through the 16 area, it might go down to 1540, and that's another long. So that's all there is to be said for it. I'm afraid we can't. We have the markets that we have, and we have to trade them in the way that the markets enable us to trade it. We'd very much doubt that oil is really going to trade much lower than 42, with 50, 51, 52 being the top. So again, we might have a little bit of a swoon towards the 45 area, 46, and again, that's where you want to buy it for the next 2-3% up. So the markets are going into summer mode very early, and it'll be a question of hitting and running, basically buying it at your level, probably in greater size than you'd be comfortable with, having a tightish stop, and then when you've made some money, don't wait for a trend to develop, get out and look for the next trade. For our part, that's definitely the way we want to play it. We want to play it with by being extremely patient, by waiting for our levels, not chasing anything, and hitting and running, and concentrating on sterling for the next month, because that's where the most volatility it promises to offer. Thank you very much indeed. See you next week.